Turkey's central bank has cut its benchmark interest rate by another 75 basis points to 11.25%. It says efforts to rein in rising prices are creating more space for policymakers to lower borrowing costs. In December, prices increased by just under 12%, but the central bank expects inflation to hover around 8% this year. The latest interest rate cut follows a reduction of around 1,200 basis points over the previous year, halving lending rates since the beginning of 2019. And that's attracting investments. The index that measures share prices on the country's main exchange, Borsa Istanbul, has surged to its highest level at 121,000 points. Well, for more on this, Murat Gulkan joins us now here in the studio. He's the chairman of OMG Capital Advisors in Istanbul. He was also the co-head of European emerging market sales for Deutsche Bank in London. Good to have you on Money Talks, Murat. Now,
to be here.
As I mentioned, this is the fifth consecutive rate cut by Turkey's central bank. Why do you think policymakers thought it was a good idea to ease borrowing costs once again?
I think there are two components to this. Number one is that obviously the 1,200 basis points you've mentioned comes starting off from a very high point. So the second half of 2018 was a very tough period. The central bank had to execute emergency rate hikes, and so there was ample room to start cutting, and so hence this immense cut of 1,200 basis points or more now. The second reason, I think, is that over recent years we've seen the central bank effectively redefine its own mandate. So while its legal remit is still officially price stability, aka inflation, we've seen that in both practice and in rhetoric, the central bank now seems to emphasize growth at least as much as inflation. So it has created a dual mandate, similar to what the Fed officially has. It's created a dual mandate for itself, and at this point in time, I think the central bank is prioritizing growth perhaps a little bit more than inflation, and so it tends to err on the side of growth when faced with these policy decisions.
Yes, and one of the main objectives of cutting interest rates has been to increase growth in Turkey. Mm-hmm. Do you think that's worked since the policy easing began in July?
Well, yes and no. Yes, in the sense that unless some very unexpected events occur, then you normally do get a reaction, a short-term reaction to lower rates, because lower rates typically come at the end of a period of pent-up demand. You lower rates, and this pent-up consumption demand tends to work its way through the system, and that's what we're seeing at the moment. With cheap loans on offer, yes, people do go buy cars. That's not a surprise, and it's a good thing. So we're seeing some boost there. The longer-term issue, I think, still needs to be addressed, and that's the fact that fixed capital formation has been effectively zero for several years now. That's the kind of activity that we would like to see lower rates impact, because that would be one of the main pillars of sustainable long-term growth. And of course, fixed capital formation, investments, it's a more complex issue, and it doesn't just respond to interest rates. So with the emergency having been taken care of, the fires having been put out, that's a good thing, but much work remains to be done.
One of those fires was the runaway inflation that Turkey was experiencing. In October 2018, inflation stood at about 25%, but as we mentioned previously, it's now sitting at just under 12%.
Correct.
Now, the easing of the cooling of inflation is one of the reasons why the central bank says they have room to lower borrowing costs. Where do you see inflation going this year?
I think the central bank's own estimate of 8% will prove to be slightly optimistic. Will probably be closer to double digit, especially with some short-term demand pressures coming through. So compared to the nightmare 25% we've had, obviously it's been a huge improvement. Compared to our official target of 5%, we're still quite a ways off. And in the year 2020, I don't think 12% inflation is where anybody wants to be. So again, I think there's some room for improvement there.
Can I ask you one last question about GDP growth? Because the Turkish government has increased its target for growth to 5% for the 2020-2022 period. Now, official estimates put growth last year at around 0.5%. So there's quite a a long way to go there. Do you think we'll see a significant rise in GDP growth over the next 2 years?
I think we'll see an immediate pickup as reflected with the short-term stimuli that we've just mentioned. But for the full 2-year target of an average of 5% to be met, if it comes through, I think it'll be more backloaded and it'll be apparent if and only if longer-term issues such as fixed capital formation begin to show some signs of life.
Okay, Murat Gulkan, we'll have to leave it there, but it's been a pleasure speaking with you. Hopefully we can speak again in the future. Thank you.
My pleasure.